Hello, and thank you for joining today's First Time Homebuyer webinar. My name is Kevin Janak, and I am with The Mortgage Solution. This webinar will be under 10 minutes, and by the end of it, you will know if you qualify to purchase a home. So this is the attention of a person who is trying to get into a home by putting the very minimum down. FHA requires you to put a minimum of 3.5% of the purchase price, or a conventional is 5% of the purchase price. I'm going to go over these two different loan programs, talk about a couple of guidelines, and afterwards tell you about our formula. And the formula will let you know whether or not if your income will allow you to qualify to purchase this home, okay? So first, conventional. They require you to have a minimum credit score of 620. FHA is 580. Do you have a credit score above 580? If you answered yes, you're looking good. Second is debt to income ratio. If you add up all of your mortgage payment, your credit cards, your car payments, everything that's on your credit report, conventional will allow you to use up to 50% of your gross income if you're a W-2 employee. Or if you're self-employed, it's your net income. And I could go over that in a different webinar, okay? FHA, it allows you to use up to 56% of your debt to income. And this is where the formula is going to come into play, because the main thing for a lender is your ability to repay the loan. Okay, so a couple more guidelines, and then we'll go to the meats and potatoes, all right? So bankruptcy. On a conventional loan, it is required for your bankruptcy to be seasoned. That means your bankruptcy was discharged or dismissed more than 4 years ago. In FHA, more than 2 years ago. A foreclosure, a conventional is going to require the foreclosure to be seasoned by 7 years, and on FHA, 3 years. Have you had a foreclosure or bankruptcy? If you answer no, you're still looking good, okay? All right, now let's go down to the ability to repay. It's a formula that we have here at the Mortgage Solution, and it's simple. You could do it. Grab a pen, grab a paper, and get ready to write something down, okay? So, first of all, the formula is this. Your gross monthly income times it by 50% minus your debt equals your max mortgage payment that you could have, okay? So let's write up an example. And as I'm writing an example, you write it down on your piece of paper, okay? So first, monthly gross income. There's going to be two borrowers on this one. They're both, first borrower, he has a gross monthly income of $7,500 a month. The second buyer also gets an income of $6,500 a month for a grand total of $14,000 a month in gross income. Okay, and again, this is for your W-2 employee. Next, we're going to times this 14,000, and we're going to times it by 50%. This equals $7,000, and this is the amount of monthly income that we could use to qualify you for a loan. Now, here's the tricky part. What is your debt? What do you owe that's being reported on your credit report? So not your cell phone bill, utility bills, your car payments, credit cards, installment loans, student loans. Student loans are a little tricky. Call me at a later time or email me and we can go over student loans. But if you don't have a payment plan, it's going to be 0.5% or 1% of the actual balance. Again, that's tricky. I'll go over that later. So for this purpose, these two people, they have two car payments. They both have a car payment of $500, and the other one has $500. Combined minimum payment on their credit cards, not what they pay on a monthly basis, the minimum payment. They have 5 credit cards total, and 5 credit cards minimum monthly payments is $300. One guy also has an installment loan of $100 a month for a grand total of debt reporting on the credit report of $1,400. So The formula, once again, gross monthly income, $14,000. You times it by 50%. 7,000 is the income that we can use. And we're going to minus your debt. The debt is $1,400. So 7,000 minus 1,400 equals $5,600. The $5,600 is your max mortgage payment that you could have for a loan. So that's great. All right, well, I could afford a $5,600 mortgage payment. Now, what does that equate to as far as a purchase price? So this purchase price is a general figure, okay? This is going to be based on principal, interest, taxes, homeowner's insurance, and also mortgage insurance. So if you do not put 20% down, the bank is going to charge mortgage insurance, okay? So the max mortgage payment that you could qualify for is $5,600. For in this case, we're combining all this, and again, this is an estimate. You're going to divide that number, 5,600, divided by 800%. What that equals is a loan amount, or I'm sorry, it's a max purchase price of $700,000. Now look around your area of where you want to live. Can you buy a home for $700,000? Do you qualify based on the ability to repay, based on this formula? Do you qualify by not having a credit score of under 580? If you answered yes to all this stuff, you qualify for a home. Whether if you think or not, you qualify. Give me a call today. Let's talk more numbers. And to validate all of this information, what we would need is 1 month worth of pay stubs, your last 2 years of W-2 statements, and 2 months of bank statements. The bank statements is going to prove the reserves, prove that you have money for a down payment. So if you qualify, give me a call. Again, my name is Kevin. My phone number is 714-318-2194. Thank you very much for attending, and you have a great day.